Welcome back, ladies and gentlemen. It's great to have you back, and it's a pleasure. I have with me Ernest Nesmith from Nesmith Rogers Financial Consulting, and we're going to talk. The two of us are going to talk about the importance of investing. And I want to get us started by, when we bring on a guest, we're trying to tie in the tenets of climb. And today, I really think we're tying in four of those tenets: care, lead, motivate, and balance. Here at RMS, um, we really believe that our employees are our most important asset. And as a business owner, I think you should believe the same thing, and you probably do. Um, so today is about caring for your employees, leading them, motivating them, and then helping them get balance in their lives, and doing all of these things through teaching them about investing. It's important with your employees to create an environment for them where they can succeed, where they can excel, giving them those tools, the support and the training they need to do that. And I think one of the things that you can do to help them personally is to provide them with the information needed to understand the importance of investing and investing early and often. So, Ernest, let's talk about that. There's something I learned a while back, a long time ago. Doesn't get taught in school, though. I think it's really important to understand compounding interest, the rule of 72.
Yeah. Yeah. So first of all, thank you for having me. I really appreciate it. The opportunity to help educate people is very important to me. So yeah, I appreciate it. In our industry, we try not to give too many things names and acronyms, but the way that we approach this, the rule of 72, is really simple. Um, it's like attacking a disease. The earlier you do it, the better. The earlier you do it, that's you have a better chance of having a full success of completely being cured, right? So in this particular case, we're talking about investing. The earlier you do it, the better. So the premise of the rule of 72 is that if you start early, you get a chance to compound that interest of your investment from an early stage. And um, once you reach a later stage, obviously you're going to have a high probability of having a substantial amount of funds. So I think we talked before that I think you have a chart or a graph that you
Yeah,
want to go over. And
yeah. Let me show that because I
yeah,
think this really blows people's minds.
yeah,
With the rule of 72 says that 72 divided by your return on investment is going to give you the number of years before your investment doubles. So
right.
so I've picked 12, and I didn't pick 12 out of the sky.
Mm,
12 is about the percentage of increase annually on an average basis for the S&P 500 since its inception in 26 or 23, whatever year that was.
mm,
So it's actually kind of a real number. I mean, we all know the stock market does this, and there's ups and downs. But
right.
over that period of time, it's been about 12%. So I picked 12%, which means that the money will double every 6 years. Yeah, that's an average, right? That's
Right.
not exact science,
Of
but for
course.
the purpose of showing this chart, it blows people's minds. So if you have you're thinking about having kids, or you have kids, if you put $2,000 into a mutual fund that was you're returning 12%, an investment that was returning 12% annually, when they were born, um, when they turned 66, they would have $3.5 million if you did that one investment of $2,000. Now watch what happens. And this is the most important part to understand. Watch what happens if I wait until they become 7. So I skip that first 6-year cycle, and I put that same 200,000 or $2,000 rather when they become set at the 7-year point. They only have 1.7. I'm only, right? Still good money, but they only have 1.7 million. They've cut it in half. But watch what happens again if I say I'm going to skip those first 2 6-year cycles. So I'm going to put that same $2,000 in, but I'm going to wait till they're 13. You've dropped them down from 3.5 million to 900,000. Um, it's incredible the difference it makes to invest early.
Mm,
Um, and I think that's the thing that we don't teach. We don't teach it in school. We don't teach it in college.
Yeah.
We just don't teach it. And to me, I teach all this to my employees. And I've got, when we're a technology company. We have a lot of young employees that are starting families. And I'm like, put the 2000 in now. I wish my parents did that for me. So anyway, I'll stop the chart, and I get a little passionate about this one, but um, so let's talk a little bit more about strategies to build wealth. And let me stop sharing this chart so we can get back. There we go.
Yeah. So the interesting thing is that, we discussed this before, which is really interesting that um, when you put up a chart like that and you put up 12%, most people think, no, that's not possible because the market, we just had a recession. We just went through coronavirus and the market went down. Well, if you look at the S&P 500, for example, or even the Dow Jones from the time of the Great Depression, the funny thing is that if you look at the chart, the stock market's always going up. So
Yeah.
if you start early, right? Yeah, of course the market's going to have its own ebbs and flows. It's going to go down, going to go up, or whatnot. But in general, the market's going up. We hit record highs in the market, in the stock market, every several years, regardless of who's in office, regardless of what the political climate is. In this case with coronavirus, regardless of all that, the market in general is going up. So what that tells you is that if you get in early, you have a better chance of success. That 12% is very realistic. It's not unrealistic, and it's all
Yeah.
a matter of perspective.
Yeah.
So yeah,
Well, yeah, and I think, yeah, that's the purpose when I show that chart, because it really does blow people's mind, because we just don't teach compounding interest, and it's the key to success in investing, is doing it early so you can take advantage of that. So, of course, when we talk about investing, we talk about diversifying and all that. So there are a lot of ways outside the stock market to I mean, it's one of the ways we do it, right, in the stock market. And some of it's with stocks, some of it's with mutual funds. What are some of what would you say some of the key investment strategies for we have people on this call that are, all people that have just started investing or even haven't, or just thinking about it, to people that, are well in tune with investing. And so, what would you tell people that are just getting started?
yeah. Obviously, if you want to keep it simple as possible, there you definitely want to look at mutual funds, right? Um, um, while I myself, that's the way I got started. I was worked for Fortune 500 company, or Fortune 100 company actually, and one of the things that I'm fortunate enough to do is that I got started at a very young age, investing into their it was a 403b plan instead of a 401k, but it's essentially the same thing. And that's a great way to get started. A load share mutual fund that's invested. You can do sectors, but in general, we talked about just the stock market. Just in general, you can invest into an index mutual fund that encompasses the entire market, and that will allow you to take advantage as well, because it's going to participate in everything that the market does. So that's really simple, easy way to get started from the beginning. If
Okay.
your company has a 401k and they're putting money in for you, it's free money. Take advantage of that. If you can match or put money in along with what the company is doing as well, it's a no-brainer. That's a great way to get started.
Yeah, absolutely.
Yeah.
Okay. And what are some of the other investment, building wealth? What are some of the other things you would recommend and do?
Sure. Yeah. So obviously, mutual funds and stocks is a kind of a basic thing, but one of the things that I know that we've done here in the past, over the past several years, that's worked really well, is alternative investments as well. That's not necessarily correlated to the stock market. Um, One of the current things is life settlement investing. So what life settlement investing is that um, you are with a group and you're buying into life insurance policies of people who might not have that much longer to live. For one reason or another, it can be a particular disease, or it could just be because they got older. But a lot of times what happened with those people is that they can no longer afford their policies. And so what happens is that the policy will lapse, and then when they pass away, their families get nothing in return for that. So what we'll do, we'll go in and buy that policy from that person, pay the premiums, and then when they, in the event that they do expire or pass away, um, a good portion of that death benefit is going to the family. So the family still is going to receive funds, but we also have responsibility to our investors. So a part of that death benefit is going to our investors. And on average, I would say we've been earning between 20 and 30% a year
Wow.
over the last several years. It's really been more like 30%, but we have to say 20 to 30% because we want
Sure.
to be conservative, and kind of lower expectations. But it's not something as morbid as it sounds because you really are helping out a lot of families, but at the same time, we get to help our investors as well to earn additional money with the money that they have.
Yeah, and when we were first talking about this before, I was like, oh yeah, that was my initial impression. Oh, that's a
Yeah,
little morbid.
yeah,
But when you think about it, that you bring up that point, it's you're helping people who can't afford the policy. The policy's going to lapse,
yes.
and nobody's going to the family's going to get nothing. So this is a very interesting strategy. What is that? What does it take? How much money does somebody have to do this with you or to do this type of
So
thing?
we have varying amounts. Sometimes we have people that just want to kind of dip their toe in the water, and they might only, put in a few $1,000s to get going. Then we have people that on the flip side of that is putting in seven, to eight figures because the
Gotcha.
return is so great. So it's a wide range.
Sure. Okay. But somebody who, has couple $1,000 that wanted to start here could get into it.
Yes.
Okay.
Yeah.
That's great to know. So, any other, you know, any other interesting strategies to build wealth?
Um, yeah, I mean, again, if we're going down the alternative vein, there's there's definitely things such as solar investing, which is really hot right now. I'm pretty sure if you're like me, you get a ton of phone calls for somebody wanting to sell you, solar panels. And the reason for that is not because they want to save you money on your electric bill. you know, the reason, the real reason for that is because solar is so lucrative right now that the energy companies are buying buying the solar units up by the boatload, and it's worth a whole heck of a lot of money. So they're willing to, in some cases, put solar panels on your house for free in exchange for them extracting that solar energy and then lowering your electric bill. And that's your return. You get to lower your electric bill. Well, there are companies out there that actually allow you to buy into solar projects. Uh, and whereas you can take advantage of those earners the same way the power companies do, and essentially, build wealth that way. And then on top of that, there's in most cases tax credits that as well that comes along with that. And that's tax credit is an easy way to put money back in your pocket too.
Sure.
It's not necessarily a tax strategy, but it is a way to put more money back in your pocket. If you can, a credit is different from a deduction. A deduction is lowering your income so that you can pay less in taxes. A credit is literally, them taking money and putting it in your pocket. And it helps to um, allow you to put that money in other places. You can take that money and then compound that growth and put it into another investment.
Okay. And so if somebody wanted to get involved with that, I guess one way is to certainly reach out to you, which
Hmm.
we will
Of course.
we'll put that information,
Right.
at the end of this, we'll post that information so that people can get in touch with you. And a solar project, just another question that I'm sure will go through people's mind. What's the low limit here to get involved in that kind of investment? Is that a higher entry point or?
Yeah, so that one varies because there are a couple ways to get involved with solar. You can get involved via like an ETF, and buy if you want to get into it, like for hundreds of dollars. If you want to
ETF?
get
Tell us what ETF is.
so ETF is it's like a mutual fund, but it trades on the market. So that's
Okay.
yeah. So it's just another version of a mutual fund.
Okay.
And so it's a very it's an exchange traded fund, but it's a cheap way of getting involved. If you want to get involved at a higher level and you want to get involved into an actual project itself, then that obviously going to cost you a little bit more money. You're probably looking at least $40,000 to $50,000 to get involved in that. But
Okay.
I just want to give you the option of saying that, yeah, you can get
Yeah.
involved at a lower level. You can get involved at a higher level too. It just really depends on your situation.
Good. Well, and like I said, we've I think on this call we've got people that are probably in all categories of where they could get started. So it's
Okay.
good to know what
Yes,
their options are.
absolutely.
Um, so we've talked about the key to success here is getting started as early as possible. And
Of
and
course.
for those that didn't get that opportunity, it's never too late to start. And you need to start now.
Right.
But once you've built this wealth, I mean, I show that chart, and that child that got the $2,000 at birth and no more money put in, but they still walk away with 3.5 million.
Yeah.
They don't really walk away with 3.5 million, do they? Because the government takes a chunk of that.
Right.
So let's turn the tables for those that are thinking or getting close to that point where they're looking to retire and start pulling money out. What are some strategies to protect their wealth?
Right. So obviously, if you're doing all the right things, the next thing is Uncle Sam is going to come calling at some point. So you have to implement some type of tax strategy to try to offset that income that you're going to be receiving later on down the line. So there are a couple of things you can do. One of the things that you can do, regardless if you're a W-2 wage earner or if you're a business owner, is getting involved into conservation easements. So a conservation easement, the really quick way to explain it is that the government gives a deduction for people who decide to give up the right to build on their land commercially. And they reward you by giving you a tax deduction that's based on what that land is worth right now versus what it would be worth if that land were to be developed. And you can in some cases, buy into a syndicated conservation easement, and that would allow you to offset a ton of your taxes because in a lot of cases, the deduction is for every dollar you're putting into it, there's about a $2 to $5 deduction that comes along with that, which
Wow.
is that's pretty
Yeah,
substantial.
that's substantial.
Yeah. So
Yeah.
with that, you have to be careful and make sure you're doing it the correct way because obviously that's something that becomes under scrutiny with the IRS and with the government. So you want to be with somebody that's doing it correctly and that's following the rules of or the letter of the law. That's extremely important.
Sure. Yeah, I had read that too. That's something that they're really watching very, very closely. But
Yeah.
there is
I
a
mean,
right way to do it.
yeah, it's the right way to do things. If you do them the right way, the returns on that is pretty substantial. I mean, if you're in that case, in the chart that you showed us earlier, that person is going to be pulling in $3.5 million. They're going to be paying the highest tax rate. So if you can alleviate half of that, which what the law allows, deduct half of that, that's gonna save you several hundred thousands of dollars in taxes.
Yeah.
So yeah, that's definitely something you want to look into.
Okay. Um, Other strategies to
Sure.
protect
Yeah.
wealth?
Absolutely. So if you are now that's for again for W-2 wage earners and business owners. This one is more along the lines of somebody that owns a business. There's a couple of things you can do. One is you can write off your home for meetings, holding meetings at your home. That can save you anywhere between or generate a deduction for you anywhere from $14,000 to $20,000, depending on the size of your home. Um, I wouldn't call it. I guess we would call it in the industry tax-free rent, but essentially what it is that you are going to charge you as an individual are going to charge your business for holding meetings in your home, the same way you would if you were to go to a hotel and rent out a conference room. If you went to do that, that's a deduction for your business, right?
Right.
Well, you can do the same thing at your home up to 14 days out of the year. If you do it for less than 14 days out of the year, you as an individual don't have to actually claim taxes on that money. And then it's a deduction for your business. So that's one way of
Okay.
really simple way of saving money. The uber rich people use their private jets and yachts to do the same thing in their
Hmm.
vacation homes. But if you're not on that level, you can certainly use your normal home to do the same thing.
Okay. And I guess some of the protecting of wealth is also built into like um, uh, Roth IRAs and IRAs, doing some of that kind of investing as well,
Of course.
FSA or HSA cards, um, taking advantage of some of those opportunities,
Yes.
and that protects things. So let me ask you, and we didn't talk about this. I hate to put you on the spot here, but
Okay.
I know this one comes up a lot. Is when should I do a Roth or should I do, when should I, when I shouldn't I? Um,
Yeah, that's a pretty complicated question. So it, it really depends on where you're at in your life, obviously, right? So we have a lot of clients who convert their Roth or convert to a Roth and go ahead and pay the taxes on that, at that particular time. Um, in a lot of cases, if you're going to do a conversion, you want to do it when your tax rate is not the highest. So sometimes that's right around the age of retirement when you're not making as much income as you were making before, and you at a lower tax rate. That would allow you not to pay so much in penalties and taxes that you normally would if you did it, right in the heat of or right, in the middle of your career where you probably earning the most money you've ever earned in your lifetime, and you're
sure,
at a higher tax bracket. So that's what we see in a lot of cases, but we also have people who want to implement the other tax strategies and choose to convert right at that point from a traditional to a Roth, and go ahead and offset their taxes with other strategies. And then that way they have that money they can pull from and without worrying about paying so much in taxes at that time. So yeah, that's a complicated question.
yeah,
It's a loaded question actually, but
yeah, right.
yeah, yeah, that's a good question.
Um, yeah, I mean, it's one I've been asked myself, and I'm like,
Yeah,
yeah, that's not easy.
yeah. No, it really depends on your specific situation.
Sure,
It's not a cookie cutter answer that goes along with that.
right. And that's really true. I mean, but one of the only absolutes I think in investing is doing it early,
Yeah, yeah,
and,
yeah.
and doing it as often as possible. Right.
That alleviates a lot of pain.
Right. The rest of it though is it depends on the circumstances, and
Yeah.
um, so okay. Any other tips or things you want to talk about either in building wealth or protecting wealth? Um,
Um, no, I believe it or not, we covered in a relatively short period of time quite a few things.
mhm.
I think once you get deeper into the conversation, it can take hours, and I've been on the
Sure.
phone for hours going through a lot of things. But um, there are definitely other strategies for protecting wealth. Life insurance being one of those. Yeah, I think life insurance is actually the basis of any financial empire. That's where, other than investing early for your children or for yourself, life insurance probably neck and neck with the two things that you should get taken care of right away, because the bottom line is that if you haven't built wealth yet and something happens to you, then you leaving your family in a real tough situation. And you want to get to the point where eventually, um, that you can self-insure, that you don't need insurance because you built enough wealth that you don't necessarily have to have insurance to cover anything. But you know, insurance probably be the other thing, other conversation, which again, that's a very long conversation.
Sure.
But but that's another thing you definitely want to begin to strategize on.
Well, and I think that takes me, that's a good segue to this is complicated. And
Yeah.
if you're trying to do this on your own, that's a mistake.
Okay.
The I think that, I mean, I think I'm a pretty intelligent guy, but this is not easy stuff. And
No.
that's not my area of expertise. And that's why people like you are out there. So I tell my employees, if when you're getting serious, you should be talking to a financial consultant, people that are experts in this field that can help you, because a lot of people don't even think about insurance, or that
Yeah.
they do, they don't really understand it. And you're right, it has to be part of your
Yeah.
portfolio,
Well,
especially when you're young and you have, a family to take
yeah.
care of.
Well, the truth
Um,
of the matter is that most people don't want to discuss insurance because insurance equals talking about your mortality.
mhm.
And so it's a tough conversation. And but like you said, it's a very important part of a financial empire. Or if you that's the basis. You have to start with that, and just starting early. You don't if you don't have $2,000 to start early, you start with $500. That's
Yeah,
still, I bet if you plugged in $500, that's still going to equal quite a bit of money at the end.
yeah,
You know,
absolutely.
yeah,
Yeah, and and that's the other thing. I show the 2000 when they're born. But that
yeah,
doesn't mean you have to put it all in at the 2000. If you could do $50 a month and
yeah,
do it for 4 years or 6 years. I mean, you're
yeah,
going to have well more than you're going to have way more than the 2000, and at the 6 year point, you're going to have way more than the 4000. So something that you
yes,
can afford to do, if you can do it monthly, I mean, that's the best way to do it.
yeah,
I mean, you can do a lump sum of 2000, that's fine too. But
yeah,
but
yeah.
if you can't do that, it doesn't have to be that big number. It just has to be start now and just keep adding to it.
Yeah, they
So
both have their advantages. If you start early and you have a lump sum, that's great. One of the advantages to buying or paying into it, like you said, on a monthly basis or um, however you choose to buy monthly, is that you get to buy in the ebbs and flows. So obviously, if you buy when the market drops, that's going to put you in a really great position as well. So
yeah, yeah,
that's value investing. I mean, if you go into the grocery store and you want to buy a dozen of eggs, if you can get them for $1 versus buying them for $3, obviously you want to buy the one that's for $1, as long as the value of is good quality. So yeah,
yeah. No, and I know personally, I have a couple of my accounts that I'm every month money just automatically goes in there, and then
mm,
I invest with it. My godson, I have an account for him
mm,
that I automatically put money into every single month. That and in the custodial account in this case,
yes,
and then invest um, every month as well. So it it, uh, it's really quite easy. It's easy to set it up, and then but I think that's it's important if you can do it. But the
yeah,
thing is, just you got to find a way
you got to
because it
start.
pays such great dividends at the end, right? I
Yeah,
mean, you see those numbers, you go, oh, I sure wish my parents would have done
yeah.
that.
You just got to start somewhere, right?
Yeah, that's
So
right. Yeah.
yeah,
Well, Ernest, it's been awesome. I really appreciate you taking the time to do this. And I understand, as we talked, that you have a couple of new potential investment opportunities and strategies later in the year that you're
yeah,
working on. I would love to have you back at that point to tell us all about that, if you'd be willing to do that.
sure,
So,
absolutely, yeah,
okay.
yep,
Well, once again, thank you very, very much for joining us for Climb. And I really do think that we hopefully we've given some people some ideas on how to help themselves and
yeah.
their employees. So, okay, have
All
a
right,
terrific day, and thanks again.
all right. Thank you. I appreciate it.